Dear students, welcome you to session 27, chapter Mutual Funds, Financial Management, 6th semester BCom, Mangalore University. In this session, let us understand the different types of returns from mutual fund. The mutual funds gives returns in two ways, that is the capital appreciation as well as the dividend. Now, capital appreciation means it is an increase in the value of the units of the fund. As the value of the units increases, the unit price increases. So, investor can book the profit by selling these units at prices higher than the price at which he has purchased these units. So, by capital appreciation, which means the increase in the value of the units. So, when the unit price increases, the investors can make profit by selling these units at a higher price. The next type of return is the dividend, the profit earned by the fund which is distributed among the unit holders in the form of dividend. And what happens is the dividend can be either reinvested in the fund or it may be paid to the investors. If a person is looking for a long-term return, generally he reinvests the dividend in the units, that is either new units are purchased with the help of the dividend or it can be paid to the investors. So these are the two types of returns received from the mutual funds. One is the capital appreciation, which means increase in the value of the units of the fund, and the second one is the dividend depreciation. In this case, we will have to understand the concept of net asset value. Now, the performance of a mutual fund is denoted by net asset value. Now, we should know that the investors are the owners of the mutual fund. The funds are collected on funds which are collected on a particular scheme. The entire amount is known as the corpus or the assets under the management. The corpus is invested in different securities. The ownership interest of the unit holders is represented by these securities. So the investment made by the investors is represented by the units. So a unit is a currency of a fund. So net asset value, it actually refers to the ownership interest per unit of the mutual fund. In other words, we can say that net asset value refers to the amount which a unit holder would receive per unit if the scheme is closed. So net asset value is the market value of the asset minus the liabilities on the day of valuation. So we have to calculate the per unit net asset value. It is the net asset value of the scheme divided by the number of units outstanding on the valuation date. So the net asset value is equal to the value of the securities minus liabilities divided by the number of unit outstanding. So net asset value of any scheme, it actually tells us how much each unit is worth. So we have understood the concept of the returns from mutual fund, that is capital appreciation and dividend distribution, and again the concept of net asset value. Thank you.